And welcome to another Capital Gains Tax Solutions podcast. We're also streaming on Expert CRE Secrets podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer millions of dollars of capital gains taxes, invest into any asset of any kind so you can create and preserve more wealth, and make timing your friend when investing. My name is Brett Swartz, and each and every episode, I'm joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together, we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's out of the great state of Washington in the Seattle area, and he's the president and chief investment officer and co-founder of Spartan Investment Group. He has organized over $200 million of private equity for Spartan's projects, and he has experience managing the development of the Spartan Investment Group's projects in challenging markets. He's also responsible for investor relations and capital raises for projects. He's a highly experienced commercial airline pilot, and he graduated from Merchurch University with a bachelor's degree in business. Yeah, and so much more. I mean, he's just really smart and cool. And we met back at the Best Ever conference a couple years ago. And we're going to be talking about navigating self-storage development and deal structuring. Ryan, welcome to the show. How are you doing?
Good. Thanks for having me, Brett. Appreciate it. Good to see you again.
Yeah, likewise. Great to see you again. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, so we own about 60 self-storage properties across the United States, about in 12 states, and we're the 36th largest operator of self-storage. We build it and we buy it existing, and we actually build approximately 500,000 square feet a year, potentially, given where we are. We do external and internal builds, so we build for others and build for ourselves, and then we are fully integrated, meaning that we have a national brand called Free Up Storage that does all of our property management in-house, and of course, we invite investors to participate in the passive investment of self-storage. And kind of how I got my start was I was an airline pilot previous to being a real estate developer, and I met my good friend and my business partner Scott Lewis as neighbors in Washington D.C. And we got our start by developing real estate and the residential side of things, developing condos and single-family homes, and then we transitioned into self-storage because we loved the fact that it was easy to own, evict, and maintain, and that had been recession resistant for the last 40 years. So we really love the asset class, but kind of getting into the space, my experience as an airline pilot and Scott's experience in the military really kind of positioned us well to put together a well-structured company and really put together a vision and a plan to grow it to where it is today. So excited to be here and to talk about it more.
That's awesome. Yeah, I love that, Ryan. And by the way, you can learn more about Spartan Investment Group by going to spartan-investors.com. That's spartan-investors.com. Ryan, before we dive into the self-storage development deal structuring business, do want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be blessing and help to others. Some people call them superpowers. I'm curious, what are those one or two strengths you believe you were given, and how does that help how you help and bless people today? Let's see if Ryan comes back here. He might be a little technical difficulties with the Wi-Fi connection. He'll probably be back in about 10 seconds here. And again, spartan-investors.com is where you can learn more about Ryan. And we're going to be talking about navigating self-storage development and deal structuring. And yes, I think self-storage is an interesting place to be in. I mostly have done multifamily and mobile home parks. And I think self-storage is in one of those food groups that can be great for commercial real estate if you're working with the right operators like a Spartan group. And it helps to diversify. People always need a place to put stuff, it seems like these days. And self-storage continues to grow. We'll talk more about that. Here comes Ryan. He's probably back right now. Ryan, can you hear us?
You can hear us. Thanks to Comcast for the amazing internet here. So.
No problem. I've been there before. So I was just doing a little plug for self-storage, but the question was this, Ryan, gifts, right? Gifts or strengths that you believe you were given, and how does it help help bless people today?
Yeah, I think that connecting with people in sales and marketing has been something that I've been able to execute on, which provides the opportunity for people to find out about the space and participate in it. And I think that's really been a thing that's been helping me connect people with the space and the opportunities. So sales and marketing, I think, is a big gift.
Awesome. Awesome. So let's dive right into the topic at hand, which is navigating self-storage development deal structuring. So Ryan, I mean, it's 2024, right? We can do like kind of a macro review and then we can go micro here. But what would you say is the number one secret to, your guys' success as far as navigating self-storage and development and deal structuring?
Yeah, I think identifying markets that self-storage has demand in is probably the number one thing. So if you think about the three things that make a great self-storage site, you want to have a great market, great asset, and great location, which is pretty common for any real estate, really. But when you think about the great market, you want to think about things like what's the rents in that market, how much are the customers paying for self-storage, and that really drives a lot of your business plan. And when you think about the asset quality, you want to have some kind of advantage, whether it's price and location, but really the advantage on the asset quality compared to your competitors. And then the location, when in self storage, we think about things like drive-by counts and visibility from the main road, access to the site that really drives customers and makes a project very successful. And so those are just kind of some of the things that I think about when you really want to get into self storage. How well occupied is the market? Are all the competitors full of self storage? Do they have good, strong storage rents? And is there demand for the product? And are customers paying what you would expect to achieve your business plan with? And then again, just having the amenities that a customer would come to expect at a property, and it's well located.
Okay, got it. So it's starting with the numbers and starting with the stats, right? So it's asset, great market, great asset, great demand, ideally, and then you are looking at the rents. You're just diving down into those numbers there, and the occupancy rates. Okay, so I guess the first one is just sheer data, right? Is maybe the secret number one. What would be secret number two to navigating self storage development and deal structuring?
Yeah, so I would probably say if you're going to develop a site, you want to make sure that people are doing enough Google searches and you're looking at Google Analytics to understand if you're building a new site, are people actually trying to find the product in your market? How many searches, how many conversions are happening? I think that's a really big a piece of it. The other thing that you want to do is you want to make sure that if you're developing a site, that you have the price per square foot that makes sense. So some markets where permitting costs or maybe the land isn't developed or entitled in a way that's going to be conducive to keeping your price per square foot to where you want it, it might completely kill a site, regardless of how much demand there is. So you want to make sure that you're looking at what your construction dollars are. You want to look at maybe some more analytics on the searches for your property. And then you want to make sure that whatever you build, you want to right size it to the market. So you want to make sure that the unit mix that you're building and the square footage sizing is correct. If you're out in a more urban area, for example, maybe more 5x5s or 5x10 smaller units are okay. If you're out in the more rural area, that you might want to have larger units, 10x15s, 10x20s. So you really want to optimize your site for what the market would come to expect, and you want to make sure that demand and that price to build it is there.
Got it. Yeah, that makes sense. So even more details on the Google Analytics. I think that's key, right? Understanding that if people are actually searching for these things, and then the actual cost to build. I imagine some states are less likely to be effective and efficient when it comes to building, or even timelines to build. Do you guys focus on a particular geographical area or location that you're finding the most success right now, and is that shifting in 2024?
That's actually changed quite a bit for us. More personal to our investment thesis and kind of building our portfolio. So originally, when we looked at the sites across the United States, we said, okay, what markets have the highest rents, great economic growth, net positive migration, favorable economic or political environments that we want to build in, where it's maybe easier to entitle or build. And that kind of narrowed down our search to about 150 markets across the United States. And so we went on this buying mission to buy properties. We bought in 12 states. And so from coast to coast, we have about 60 properties, which is sounds like a lot, but it's actually quite spread out. And so when you think about where you want to build where the demand is, or you want to buy where the demand is. Now our focus has been on filling in the gaps of where our properties are. So we're trying to become more economically scalable in the markets that we're already serving. So we're looking to have or acquire over 150,000 square feet in any markets that we're in. For example, we have a property in the southeast Georgia area where we own about 50,000 square feet, and we're adding another 70,000 square feet in the next month because we want to get more scale in that market so we can be more efficient with our payroll, or marketing, or spend. And so, now that's kind of how our strategy has shifted in 2024 to more filling in the gaps and where we want to buy.
Yeah, it really sounds like it was demand for foundational places that you place the assets in the first 60. And then at the second phase is for scalability, which is when the current places that you have, making those super efficient. Is that a fair summary?
Yeah, exactly. I think it's really important that, if you just buy one property in the middle of nowhere, but with no other assets surrounding it, you've got to spend time and effort and dollars to go to that property. And then you might have to staff it in a way that has backups. Self-storage only has one or two employees. So if one employee is not there or sick or whatever, your facility it can go unstaffed, which is okay in self-storage because it's a very automated business in general, but you still need somebody there. So I think just having scale in a market and filling in those gaps is really going to pay dividend for us in the future.
Yeah, we're talking with Ryan Gibson, Spartan-investors.com, Spartan-investors.com. So let's talk about the areas that you are the most bullish on. Are there any new demand areas that you're seeing, like this is a good place to go into? Florida, Texas was all the rage for so long. Are they still Florida, Texas, right? Or are you really just laser focused on just scaling, or is there anything new at all that you guys are looking at for any new markets?
Yeah, I think market fundamentals are still there in the Southeast. Most of our portfolio comprises Texas, Tennessee, Georgia, and Florida. That's where a high concentration of our assets are, and that's where a lot of people are moving. I mean, when you look at maybe the Savannah, Georgia market, or you look at Florida, where the population is just absolutely booming. I mean, Florida is the fastest growing state in the nation, so we look for those high net migration counties within Florida, and then we dive in a little bit deeper into what parcels can we find and build and develop new storage on, and it's been paying dividends. We likewise have been focused on the Pacific Northwest and buying more properties in the market where we have a little bit of scale and where the rents are strong, and the foundation of the economy is really good with Amazon, Google, Microsoft, Boeing, Starbucks, all these different employers that are here that are driving population to the area. That's where we want to go. We want to go where the puck is going, and those markets are still continuing to be very favorable. We're staying away from markets that have declining population growth or that don't have the economics that for the long term will sustain a good project.
Okay, let's dive into deal structuring, right? Because we talked about kind of just self-storage in general, but and ways to find deals. But what's the best way that you found to structure deals these days, and or just the ones that have always worked for you guys when you're going in to make it a win-win for the seller and for the buyer and also for the investor?
Yeah, I think there's kind of two different deals you can buy, right? You can buy an existing property that's already built that has tenants or maybe just was recently delivered, and then you have ground up development. And I would say in any ground up development project, you're going to take on a lot of risk in the entitlement and the development of the site. And so, working with the seller, you want to make sure that to the extent you can, you want to mitigate your entitlement risk so that when you buy out that property, you can do what you want to do. That's entitlement. So you want to make sure you might have a site plan development approval in hand at the time you close, or maybe even all government approvals that would get you out of the ground to build a self-storage. That might include your building permits, which are different than your entitlements, right? Entitlement just says, yes, you can build here. The building permits is, okay, you can build that exact building to that specification. So having those things out of the way before presenting this to an investor can be highly beneficial to the investor and really reduce a lot of risk. So that's kind of what we focused on in the ground-up development side. On the structuring of a existing asset, you want to look at what the rent roll is, what the market is, and all these things that would play into, hey, the seller is demonstrating that the property can perform or is performing to this capacity. You're basically verifying that, and then you're making sure that everything that's been represented by the seller is favorable. And so you want to structure an agreement like that looks at that has time for feasibility and due diligence to go through. And we have about a 700 point due diligence checklist that we go through to kind of validate that all the things that the seller is saying is makes sense. And that's really due diligence. And I think structuring your due diligence timelines to align with making sure that you have a site that you can buy and operate to your specifications is highly critical.
Okay, I like that. What about in regards to the structuring of the sale? Are you guys with financing going on right now? With it's more expensive than it used to be.
Yeah.
Financing is always going on, but with the increased interest rates, and maybe the a little bit higher down payment requirements, about 5% more what we're seeing. What are you seeing with self storage financing, and how are you structuring maybe either seller carryback deals with the sellers, or what are you doing there to make it a win-win for everybody?
Yeah, that's a good question. We actually launched a debt fund to help us finance new construction and existing purchases a little bit more efficiently. And so we've launched that strategy. The other strategy is really just kind of the same old blocking tackling. We go to a local bank next door or a regional national bank that lends to self storage or that specific property. So we found that that works just fine still. And you're paying between 7 to 8% potentially on a rate. For the more institutional quality properties, you're going to get down to the low sixes in this market right now. Class A stuff with bigger loans and better product, maybe from the life insurance or life cos that are lending to self storage. But I would say that fundamentally things have not changed all that much from prior to the interest rates going up from a structure standpoint, right? We're going out, we're seeking a loan, we're getting first position on the property to a lender, whether that's a local credit union or a local bank or a national bank. That really hasn't changed all that much. But you're right, more equity is required, and that makes for a less efficient capital stack, because not only are you putting down more equity, which reduces returns for equity investors, but also it reduces risk as well, because now you don't have as much debt on the property because the bank is now requiring you to put down more money, and that's to keep their DSCR, their debt service coverage ratio, in line with what the higher interest rates are putting on the property. So bigger down payments, higher interest rates, and lower cash flow is what we're seeing as a result of that, right? Because if you have to put in more equity and it's a higher interest rate, generally you're going to see a lowering of cash flow. So there's that, and there's always the opportunity in any market to do seller carryback. I think that's something that's always on the table for negotiating, something that we can certainly try for, something we've done in the past, and that's something that can play very favorable if the seller is willing to do that, because you might get a lower rate and you might get better leverage terms to produce potentially better income.
Yeah, that makes sense. Speaking with Ryan Gibson, Spartan-investors.com, Spartan-investors.com. Ryan, where's capital coming from these days for you guys? Has it changed in the last 12 months? What percentage is it typically from your existing client base versus new investors? And how much capital are you guys raising in general on a year-over-year basis?
Yeah, I would say we're raising close to about $100 to $120 million a year in capital. I would probably say 60 to 70% of that's coming from existing investors, kind of repeat investors, and the other percentage comes from new, although that's changing all the time. And I would say that our base hasn't really changed. We're still raising money from individual investors. Our minimums are 100,000, and we've built up a pretty good stable of passive investors who are just regular, mom and pop investors, all the way up until, more sophisticated investors as well. So I would say that the avatar of the investor hasn't really changed, but I would say we've increased our minimums up from 50,000 to 100,000 recently. And I would say that investors are, repeat investors and new ones as well that come from referrals.
Okay. I have a thought for you, right? So I don't know if you remember at the Best Ever Real Estate Conference I met you, I spoke on stage and I spoke about crypto, exiting crypto, deferring the tax, and going into commercial real estate funds or syndications, right, as a way to diversify. And I think it's interesting now that the crypto crash was a train wreck. We did about 13.5 million for two clients. They exited out of crypto before the crash. Now it's storming back, right? I was last week over 61,000 a coin for Bitcoin. just the thought of that, Ryan, I feel like there's a lot of people who would love to get out of crypto when it's high, defer the tax, and invest along someone like you guys who have a proven track record with self-storage facilities and diversify a little bit. Just think about that, right? Like what would that mean if and I don't know how much capital you guys can even bring on. Like, is there a part where you guys say, hey, slow down, like too much capital? But what would that mean if you could exit crypto and invest with you guys all tax deferred?
Yeah, I mean, I think it's always a great strategy to have real estate in your portfolio. I think having it having an allocation of a certain percentage based on your personal financial situation is always an excellent idea. And I'm not as familiar with crypto and don't track that market as closely as everybody else does. But I know that real estate can be a great investment and can make a really stable part of the portfolio. With self storage particularly doing so well in its historical performance over the last 40 plus years. It's really been one of the top producing asset classes and is a great way to just lay a nice foundation in your portfolio.
Absolutely. Before we dive into some of those returns, I want people to know that you can go to capitalgainstaxsolutions.com to get your exit plan started. And we've done it with businesses, real estate. We've saved 1031 exchanges. And we're doing it with crypto as well. We were the first to do it with crypto, and we want to show you how to do that. You can exit, defer the tax, and invest into passive or active real estate deals, diversify your wealth, all tax deferred, no timing restrictions. Go to capitalgainstaxsolutions.com. Ryan, so talk about the returns a little bit, right? So what kind of returns are you guys actually seeing? Are you guys achieving actually? What's kind of been your guys' track record so far?
Yeah, we've had 14 full cycle exits, and I don't have the average offhand, but we have hardly ever not produced at least a 20% return annually to investors on the 14 exits that we've had. And we've never lost investor capital. We've never had a capital call, which is great. And the nice thing is investors have benefited from monthly cash flow from some of our investments, paying every month. And also investors have the upside potential to make, double your money in 5 years, which is really our typical kind of investment thesis is, hey, you put in 50K, you get 100K in 5 years. So that's kind of been our focus, and investors have really benefited that for the last 10 years that Spartan's been around.
Nice. And by that, that would be the cash flow along the way. So let's say it's $100,000, right? Maybe give me an example, right? Would it be like 7% on average, 6% average cash on cash per year? And then year 5, there's an exit, and then summing all of those totals up plus the exit would be like doubling the money. Is that a fair summary, Ryan, or would you add to that?
That's a great projection summary. Yeah, that you've nailed it.
Yeah, and then you also have what's called the tax flow benefits, right? Where you guys do cost seg studies for the depreciation, which could offset a lot or a majority of that cash flow along the way. However, what happens when the exit? Are you guys typically just buying another property and then people are putting a lot there and doing some of that cost seg? And although cost seg looks like they might be, to get the bonus back up again, right, for the 100%. Talk a little bit about just the tax flow aspect of investing with you guys.
Yeah, so our goal for our investors is to defer their taxable gains as long as possible. So the things that we've contemplated doing and have done, drop and swap is a great methodology. So if you if we're selling a property, we've given our investors the option to 1031 exchange into something else. So put in 100, you got 200,000. You get that equity back, and we say, hey, we're selling the property, but you have the opportunity to roll 1031 exchange into something else and defer the gain. So we've done that before with our investors, and also we've done entity sales where we're able to defer the capital gain as well, because we want to give our investors, we want to keep your money working really hard, and we want to keep it we want to work it tax efficient. So those are some of the things that we've done to provide our investors a tax deferral strategy when things sell. But then also bonus depreciation. We do cost segregations on every property we buy, and we fully bonus depreciate it within the first year. And this year it's 60% of the short-term life. And hopefully Congress finalizes that tax bill that brings it back. I think it made it through the House, and hopefully I think it's made it to the Senate, or it's close. But anyway. That's something that we do to, basically provide investors with the most tax efficient strategy as possible.
Yeah, I think so too. And we're hoping it does get through all of the powers that be. So the 100% bonus comes back because that's a powerful way to build wealth, where you can sell any asset of any kind and essentially invest in real estate property, and then be able to do to defer that capital gains taxes because you get that passive loss. Now you got to be careful with passive versus active. There's some stuff there, right? So check with your CPA. But generally speaking, passive is with passive, and then cost seg is a way, if you're investing passively, to offset that capital gains taxes. Might also be active, right? Any thoughts on that, or do you know if it's both?
Yeah, so I guess to your point, I think it's a very complicated topic, but to simplify it as much as you can, passive income is just that. It's passive income. The income that you earn from the losses that you get from depreciation and the losses you get from these investments usually can't be offset against your active income. So if you're doctor, lawyer, pilot, attorney, engineer, whatever, that's active income. And so the passive losses you receive from these investments you usually can't use against your active earned income. And again, I'm not a tax or a CPA, so please do your own research on that. But if you're a real estate professional, if you're a real estate agent or you're a real estate developer, and most of your income is earned from doing real estate, you can qualify for the real estate professional status. 750 hours, 500 hours of specific interest in the real estate market. And again, check all this stuff. You can tend to be a real estate investor or active real estate, and if you qualify, you can use that against your active income. And even if that's you file joint or if you're married to a spouse. But generally, most of our investors, they're high net worth, high income earners, and they're not they're not real estate professionals, and passive income can be used for passive activities. So.
Absolutely. And with that, you ready for the lightning round? Because we're running out of time.
All right. Sounds good.
All right. Knowing what you know now, Ryan, if you could go back to your 25-year-old self, what's the one golden nugget to make sure you tell yourself to do?
I would hire more qualified people sooner in my business adventure. I think in the beginning when you bootstrap, you sort of, think you can only hire who you can afford at the time. And I'd go back and say, go hire the best and the brightest right away, and do whatever it takes to pay them whatever they need to be paid to get on and get going, because you'll scale a lot faster and a lot more efficiently.
Excellent. Question number 2, what's the number one book you've recommended or gifted the most in the past year?
I think What It Takes by Steve Schwartzman, founder of Blackstone, is my favorite book.
I love that book. By the way, I'm halfway through right now on Audible. I love that book. Am I Being Too Subtle as well? Sam Zell, incredible book. Next one, what are you most curious about right now?
I'm curious to see what's going to happen with the economy. I'm sure, as a lot of people are. I mean, we've got a tremendous economy. Rewinding. Right? The government dropped in trillions of dollars during COVID, and increased the money supply substantially, which also increased inflation with all the geopolitical things that we have going on, all the money that's been dumped into the market. And we've sort of had this environment where people aren't working as much, and jobs are abundant and employers have been scrambling. But now we're in this high interest rate environment going on, I guess now 18 months, I guess, is when the rates started going up, maybe 16 months from now, from or previously. And, you still see the economy running, pretty strong. All the numbers are coming in really strong. Inflation seemingly has come down a little bit, or it's come down obviously from its peak. But, it's kind of stalled the sales market for sales, for residential sales. And, it's kind of like, what's going to happen now, right? Like, how long can we continue to sustain this amazing economy with these high interest rates, especially in this market where, we see office failing, we see a lot of loan defaults, and, things are kind of slowly happening, but they're happening. I'm kind of wondering, like, how is this going to play out? Is the market going to recover? Real estate's going to come back? And is the home market going to start transacting? I mean, particularly in Seattle, the market's very hot. I mean, there's offers on the few properties that get listed and sold. But what's really going to turn on the supply of housing again, and what's going to happen in that market? I'm really very curious to see how it plays out.
Yeah, absolutely. I agree. By the way, how are you guys doing on your debt? Were you guys able to fix your debt not have any kind of crazy rate caps that are expiring?
You know, we actually have never dealt with rate caps, and that's because 99% of our debt is fixed rate. We have one one loan in our portfolio that's got a floater on it, and it was a SOFR 205, so SOFR plus 205, which is actually a pretty good rate. That means translation, that's about 7.25% today, which isn't bad. Could be a lot worse, but all of our other debt is fixed, and our next maturity isn't until late 2025. So our debt has been very good. We actually, it was painful at the time to take on fixed rate debt when everybody was taking floating rate debt and it was cheaper and it cash flowed better. But everything that we've taken on has always been a fixed rate. Out of the 29 or 30 or so loans that we've taken on our self-storage properties, most of it is fixed rate debt. So we haven't really had the struggles that multifamily or some operators have had that have taken on floating rate debt. And so I'm very grateful for that during this time. So fixed rate debt basically means the rate doesn't change. And you don't need a rate cap to take that on for those listeners that might not understand what we're talking about. But the one floating rate debt loan that we've had, I think seemingly has peaked and might benefit from a declining rate environment if we get into that in 2024.
Ryan Gibson, this has been awesome, man. I appreciate you sharing it. By the way, it shows the discipline you guys had, right? When everyone else was, it's like the Warren Buffett. You see who's been skinny dipping, right? Once the tide rolls out, and I think a lot of people were taking on a little bit more than they should have or could have with aggressive interest rates or non-fixed rate debt. And now with interest rates going where they're at, and no one would have known, like everyone keeps saying, well, no one would have known. Well, it happened. And those that were more disciplined like you guys are not in the same situation that a lot of people are. They're having to take capital calls. They are having to renegotiate with banks, and they're probably going to have some foreclosures in 2024 for those that don't. So we'll see what happens. But that being said, Ryan, for our listeners who want to get in touch with you, would you mind one last time what's the best place for them to find you?
Yes, just like our website, but just put Ryan at Spartan-investors.com, or you can go to our website, Spartan-investors.com, and I'm happy to connect with you.
Awesome. Thanks, Ryan, for being on the show. I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions Podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, including cryptocurrency, right? Which is our big focus right now for 2024. We think it's the best opportunity to exit crypto and buy real estate and perhaps some discounted values because of what we've been talking about this whole time with the debt being where it's at. It's a great time to exit high on crypto, defer that tax, and buy in with some stuff that perhaps is down by 5, 10, 15, 20%, especially commercial real estate properties like with groups like with Ryan Gibson at Spartan Investors that are self-storage, multifamily, mobile home parks. Now is the opportunity to do that. You can go to capitalgainstaxsolution.com to get started. And also, if you're exiting any other assets, it could be a business, real estate, and you're looking to defer the tax and do the same thing, we can do it as well with those. Just go to capitalgainstaxsolution.com